A mixed bag of data came in this week, but it looks like it's good enough for the Federal Reserve to continue cutting rates, which is good for gold. Let's take a look. Before we begin, remember to like this video and subscribe for more economic updates. On Wednesday, the Labor Department confirmed that inflation remains a problem for Americans, reporting that November's Consumer Price Index accelerated on both a monthly and annual basis. Monthly CPI rose at a pace of 0.3 of a percentage point last month, 0.1 of a point faster than in October. Year-over-year inflation climbed 2.7%, also 0.1 of a point faster than the previous month. Both numbers were in line with economists' projections. As for core inflation, which strips out volatile food and energy prices, those numbers also underscored the stickiness of price pressures right now. Monthly core CPI rose 0.3 of a point for the fourth month in a row, while annual core CPI remained at 3.3% for the third consecutive month. Despite the continued inflation stubbornness reflected in November's consumer data, the consensus opinion remains that price pressures are largely cooperating and rate cuts can proceed into the new year. Not everyone is convinced, however. Scott Anderson, chief U.S. economist for BMO Capital Markets Economics, said in the wake of this week's CPI report, "The Fed will need to see more improvement on the inflation front in the months ahead if its plans for a steady pace of additional rate cuts next year is to be fulfilled." One thing we know for sure is that there was no sign of any improvement in inflation at the wholesale level last month. On Thursday, the day after the CPI release, the Labor Department announced that the monthly producer price index rose at a pace of 0.4 of a point in November, accelerating from 0.2 of a point in October. On an annual basis, PPI climbed 3% in November, up sharply from October's 2.4% rate, as well as the 2.6% rate projected by economists. Monthly core PPI rose 0.2 of a point last month, same as October and in line with projections, but annual core PPI did speed up to 3.4% from October's 3.1% rate. Despite the hotter inflation prints, the Federal Reserve is still expected to cut rates when policymakers meet next week, with markets currently indicating a 96% chance of a quarter-point reduction. Finally this week, we're only 2 months into fiscal year 2025, and already it's beginning to look as though the annual budget deficit may come in at a bigger total than the $1.8 trillion shortfall racked up last year. On Wednesday, the Treasury Department released its monthly statement for November, which showed the deficit grew by $367 billion last month, 17% higher than November 2023. This despite the government receiving revenue of $302 billion for the month, which is about $27 billion more in receipts than it received the previous November. Through the first 2 months of the current fiscal year, the deficit has grown to a total of $624 billion, 64% higher than the cumulative total at the end of November 2023. That's it for now. Thanks for joining. Make sure to check back with us on Monday when we continue to update you on what's going on in the economy. This is Devlin Steele for Augusta Precious Metals signing out.